All right, welcome to a video review with Cozy Trades, and today I'm joined by Tavi from Crescott Capital. It's been a while. We last did our update in November, a little holiday preview, so now we're doing one as we go into the spring, video titled What's Next. So we'll both be looking at kind of a follow-up on stuff we saw near the end of last year. A lot of that has come to fruition with coronavirus ended up being a huge trigger for a lot of stuff we're looking at. So I'm gonna let Tavi kick it off, and first starting with the look at the U.S. consumer confidence.
Hey guys, how's it going? Thanks for having me again. Yeah, let's just talk about this chart real quick. This is a consumer confidence in the U.S. here by the Conference Board. What's interesting about this chart here is that there's a lot of talk recently about when are we really going to bottom in equity markets, given how much is markets really peaked in February, and it's been was down at the March lows close to 30%, and we've been seeing a lot of people talking about when is the time to buy markets in general. I've never seen the market really bottom with U.S. consumer confidence near its peak, as you can see in this chart. I also never seen markets really bottom near record valuations, which is the case still. We're about 15, 10 percentage, 20 percentage points or so away from record overvaluations across multiple fundamental factors that we look at. The Michigan consumer confidence just came out, and it's a great place to sort of look at. It breaks down into so many ways in terms of looking at demographics and types of people in general that are that have consumer confidence measurements, and it gauges in a way that we're also not seeing consumer confidence at the bottom yet. I think that it's important to note as well what's going to happen with the earnings release with equity earnings were already falling in the Q3 and Q4. If you remember, I think I shared this chart with you guys the last time, and it's still the case here now, and I think it's going to get a lot worse. We had one way to sort of predict that is just look at car sales down about 40%. Car sales is pretty good because it actually correlates with a lot of other things, and it's easy to see how that correlates with other parts, even the GDP as well. But the venture capital industry or the private equity industry really started to fall apart in July of 2019. And since then, we're just seeing this as continuation of deterioration in macro indicators in general. And the second chart here, I just want to talk about a little bit of it's the global equity market cap losses that we had or so far this year, which as of today, it's about $20 trillion of losses. It's massive. I mean, at the March lows, I think this was close to $30 trillion of losses. Now, this is just public markets, right? If you include real estate, private equity, commodities, and some other markets, I think it's in north of $50 trillion of losses. Now we're seeing the Fed come in with another about $6 trillion of stimulus, $2 trillion already in place. I think personally, with a broken government, I don't think this is enough to fix the problem. I think monetary and fiscal policy is it's not enough to quell this losses in asset prices and the dollar shortage problem that we have in the world today. So I think we're likely to see a lot more money printing going forward, which brings me to the next chart, which is precious metals, which is silver. And I think silver is in a very similar setup as it was back in late 2008. You can see in this chart here that it's the Fed printed close to $1.3 trillion in 2 months back in late 2008 or so. And at the same time, silver just went parabolic over the next 2 years. I think today we're in a very similar setup, and the Fed already printed close to 1.9 trillion in the last 40 days. I think they just announced another 2.3 or so to go. And I think when you look at gold to silver ratio, back then when silver went parabolic, it was close to at the 80 or so. Right now, we're 35% higher than that, and we're close to record levels on that ratio. So I think that gives you another reason to buy silver today, along with precious metals in general. We can get into that if you would like to. But why precious metals, right? I mean, the whole reason why precious metals is on the next chart. which came out from or empirical analysis by looking at yield curve inversions in the markets. What we found is that every time the treasury curve gets inverted by about 70%, in other words, if you look at all 45 possible spreads in the yield curve, and about 70% of those are actually inverted, the best assets to own during those periods is to buy gold and sell stocks. When I mean sell stocks, I mean short stocks, especially at times when you have this commodity to equity ratio at historical distortions here. So we are close to a 50-year low on that ratio. And it makes me think about buying gold, right? Because I think gold is really the one place where it can act as a safe haven. And you don't have to have an opinion on inflation so much. Quite the opposite, actually. I think that most people don't talk about a lot about this, but I think the one reason why we haven't seen inflation yet is because commodity prices have kept so low for so long. It's been one of the worst decades for commodities in history. And I think that's a major reason why we haven't seen inflation yet. So I think this trade is betting that commodities could actually outperform equities going forward, and that at some point will generate inflation. So I think that's my view overall. And then as a mix to the commodity side, along with precious metals, I think it's interesting to add a little bit of oil. I think there's more recently we were extreme pessimism. We had record contango. We had the largest spike in energy credit spreads. And at the same time, if you look at energy stocks today, they're trading at 0.3 times revenues, which is not usual to see that across other industries and sectors. So I think that's another interesting deep value opportunity in the markets today. But the precious metals industry truly is the one industry that could actually benefit from all this QE to infinity lunacy that we're hearing. It's the one industry that actually not just benefits from that, but also is trading at the 1980s levels still. So I think that's a tremendous opportunity in the markets today on the long side. I'm not just pessimistic. I think it's hard to have a very bullish view on the economy. I think we have reached a level of economic activity that is probably not going to come back to levels that we had in the last years or so. I think we're going to now probably going to see some sort of recession to depression sort of scenario. And I think that it's where commodities will start to outperform equities going forward. I think there's a lot of opportunities. There's nothing to be just talk about the fears in the markets today. I think there's a lot of opportunities, a lot of things to look up to, and commodities is one side of that long portion that we have in a portfolio today.
Yeah, I completely agree. And this is a great looking chart on commodities. It's interesting you bring up oil too, because I think with a lot of the OPEC news lately, it's definitely been trying to carve out a bottom, but it'll be to be seen if I think if the bottom's in or not. If the 10 million barrel a day cut, and you have Trump jawboning a deal that already happened, saying it'll be double that. So it'll be interesting to see how that plays out. But agree. I mean, you see in the energy space some of the huge names down at levels they were in the 2002 to that, and in the 1990s. So there's definitely a lot of opportunity in the energy space. I'm not completely sure if the bottom's in there yet, but I mean, if you're buying for the long term, I mean, I think that's definitely something you should look at. And one thing I wanted to ask you too, Tavi, on the buy gold front, are you looking at miners? One thing I would say also notice, I mean, there's so many ratios when you're looking at precious metals like gold to silver. I like looking at the gold to GDX or to miners, and then also the JDX to GDXJ, just seeing how the juniors are doing. I've kind of noticed that as in times where there's kind of risk on in gold or risk off in other places, it does seem that the juniors outperform. Is that something you've noticed? And when you say buy gold, do you look at miners?
100%, yeah. I think miners is a large portion of our positioning towards precious metals. We've been doing a lot of due diligence in the industry, especially in the early discovery types of companies and juniors, where you can find really those 10, 20, and even 50% free cash flow yields out there. I think my view is that, like I said, I think commodities will outperform equities. So if I'm wrong on the equity side, actually continue to go higher. Let's say we even hit S&P 500 new highs here for the year in the next weeks or so. I do think that precious metal stocks will actually outperform the overall market, which has been the case. It's the one V-shaped recovery that already happened If you look at GDX, GDXJ, any index that follows the miners already, that's already happening. The difference between that and oil, and I agree 100%, oil is a very tough, it's very tough to call the bottom on oil, especially because it's such a cyclical commodity. But the whole point here is to look for asymmetrical bets in case you're wrong on shorting stocks. And I truly believe that if you look at, for instance, since April, the beginning of April, actually oil companies outperform even miners. It's up about 33% or so, XOP, the producers, which is pretty interesting. I think that's, I have a very small portion of that in the portfolio. It's not a large portion. The precious metals as well, where I think most of the deep value opportunities really are, given how depressed the whole industry has been since 2011. At the same time as you had gold held up so well during this sell-off in equity markets, where we have a bunch of margin calls and people selling literally every asset. Even gold got hit during this market crash more recently. And I think that's what's interesting here is how gold kept up so well, even relative to oil. If you think about that gold to oil ratio, for instance, that's another reason for buying miners, because that improves their own margins as well. So I think the future for miners is really bright, and I'm excited about the whole industry.
Very good to know, and I think it's a very well laid out pitch for it. So, and it's hard to disagree. It'll be interesting to see if we break out here in coming weeks, since you kind of have been tracking the equities. I was kind of pointing out some parallels today between the NASDAQ and gold in terms of kind of the zigzag up structure we've seen off of the recent lows. So it'll be interesting to see if there is one more turn down, or if they kind of just break away from equities if those turn and gold just keeps going. So now shifting a little bit to out of commodities and to equities, covering some charts I've been looking at recently. One thing that I've been really on top of recently is really looking at SPX over the long run, looking out and zooming out all the way to the monthly. And this is a chart that I have pinned in my Twitter profile and something that I've been talking about, but basically looking at the retracement in from the 2008 or 2007 highs to the 2009 lows over that period in time during the last recession we saw. Drawing a Fibonacci off of that, you can see that we nearly hit a perfect 300% extension at 3,394, all by like 50 cents, which is sort of crazy. So it's always interesting to see how the math figures into these things. And if you're not familiar with the Fibonacci levels, I would definitely say it's worth researching and looking at for your own analysis if you're new to trading and doing a chart technician type work. So and then also one thing to note here, looking at this chart, you can see we've bounced back. We sort of held the 200% extension, 2,485 on a closing basis for the SPX, and basically this is about where we bottomed out in December 18. Obviously had a huge tail candle go way below in March. And what will be interesting here is if we come up and test this 2,900 area. This is where the middle Bollinger Band and also the 13 EMA on the monthly are. And you can see when you look at the reaction off of the initial bounce in 2000 and also in 2008, they were kind of capped to that level, and you actually saw a cross of the 13 EMA and mid-Bollinger. So it'll be really interesting to see if we do get a little more juice in the equity markets over the next week or two with OPEX and earnings kicking off, if it is able to kind of go up and clip that and turn before the end of the month. And then there's also a lot of implications as well as we start a new quarterly chart bar as well, which we'll get into some of that in the next chart or two charts from now. And then one thing I wanted to look at on the Dow, obviously I think SPX, Dow, SP 500, the Dow, and obviously the NASDAQ, the three major indices to track in the U.S. equity markets. So looking at the Dow, this is a chart I've also been really focused on. We basically broke out of the megaphone late last year, and this was something that Tavi and I were talking about in the holiday preview in late November, basically saying like, hey, this looks like it's slowly going to keep going, but it's hard to be convinced that this is truly a new bull market. Basically, I think we caught a lot of people into the start of this year with that narrative. And you can see divergence show up on the weekly, for example. Pretty rare to see on the Dow. You can see each time it suggested trend change in the near term. This time was no different. Had a huge move down, and ended up actually breaking a trend line from the 2009 lows on this move. And you can see in 2016 it held, in late 2018 it held as well, going to 2019, and this time we just completely cracked it wide open, and also lost the 200 EMA on the weekly too. So you can see right now we're coming up and back testing that lost level. 24,000 on the Dow, also a key support level. So kind of eyeing what happens here if we're able to, stay under it this week or overshoot and close below it the following week into the end of the month. It'll be interesting to kind of monitor how it acts at this back test. And then, as I alluded to before, lastly, just looking at quarterly charts, we had a quarterly sell signal, and I don't think a lot of people look at the quarterlies, but zooming out even further from the monthly, looking at SPX and the Dow Jones Industrial Average, you can see that we've had a quarterly MACD bear cross, which the past two times that they've occurred confirmed the past two recessions in the .com and the housing bubbles. So something to think about now. And look, we've obviously retraced a decent amount of the down move. You can see we're kind of coming up the candle, but it will be interesting to see how Q2 closes. It looks like if Q2 were to stay below the 13 EMAs or the middle Bollinger Bands on these quarterly charts, that it would imply that there is a lot more downside to come, and you could see a revisit or a push to the lower Bollinger Bands on these charts, which is what you saw on the next leg down in the previous two recessions. And one thing that's interesting to note here as well, and should call out, I'm not showing NASDAQ. NASDAQ has been way stronger on this bounce. You've seen Microsoft kind of lead that, and then most recently kind of had Microsoft stall, and there's been almost like some sort of rotation or pushing into Amazon, and now it looks like Apple might try to participate in a little more upside as well. So NASDAQ has actually yet to see a sell signal trigger on the quarterly, so that's something that we'll obviously monitor. But if these were to turn back down, which at the moment I fully expect that to happen, you would have, I think, NASDAQ kind of lead and then get that next sell signal, and that would kind of probably confirm the next major move down, and that we would see another wave down to new lows, and the indices are at least testing the recent lows put in March. So, and with so much going on in the economy, a lot of people, I think, that are new to trading or haven't shorted the market before, really I get pinged from people every day that aren't traders who are friends, are saying, why does it keep going up? What's going on? You guys have to remember that the stock market isn't the economy. Obviously, the two do go hand in hand, but it is possible for things to lag. So it's the stock market is basically a large discounting machine, and as people's views change, if there's a odds increase that we'll be back online for May with lockdowns ending across the U.S., then that increases the odds that maybe we'll see some economic activity pick up. But I'm also in the camp similar to Tavi that I think there's going to be a lot of long-term kind of effects felt from this, and the fact that coronavirus occurred and has led to some economic shutdowns. I think it's merely a trigger and a bigger kind of a trend change that you could basically see coming late last year. You just didn't know what would end up being the trigger that ended up being. So, Tavi, do you have any other thoughts to add on some of this? And I know I'm pretty much echoing some of the stuff you've looked at as well.
Oh, no problem. No, I agree with what you said. I think that it's important to know this issue with earnings, because it's likely going to be plunging. I don't think anybody is going to be a huge surprise in terms of that. But as consumption is also plunging at the same time, that has an impact on tax revenues for governments. At the same time as you're having spending in general, government spending is surging. And economic activity is plunging. So you have that deficit relative to GDP ratio now at levels like we only seen probably in the World War II or so. So it's, right. I think there's another reason for you to rethink of your positioning and think about gold and think about precious metals, think about the economy itself. Are we at the bottom? And the labor market just started to really move. And I'm talking about unemployment rate. Look at unemployment rate, we're still just starting to move higher. I think there's a lot more to go here. Every time you don't look at your unemployment rate number itself, look at the year over year change of that. And when you look at that, usually the average, we're now at a 16% growth year over year on that. And the average recession usually lasts about 12 months or so. So, use that as your guide. I think there's a lot more to play out here going forward in terms of the downturn.
Yeah, I think it'll be interesting to see, especially over the coming weeks. And the market can obviously I always like to think and tell people that are new to trading that the market is designed to try to trick as many people as possible. That's the only way that you can fuel large moves. That's kind of why you saw such a large move at the start of this year out of kind of the melt up last year on the new bull market calling for Dow 30,000. That never even happened with all the cheerleading. And so you can see obviously little delays or the market kind of not really act like it should, but at the end of the day, the economy really matters. And I think in terms of unemployment, we're seeing something that has never happened if you look back in history. So, and with that's kind of our little presentation to you guys today, a little update on what we're seeing in the market. Obviously, if you're watching this, you're probably familiar with GuruHaven. We'd love to have you come check it out. If you haven't signed up for the site, we host it on a Slack workspace, super easy to sign up on the website at www.guruhaven.com. And we obviously have a newsletter that goes out too. Tavi's way too cool for the newsletter, so he enjoys doing his videos with us. But check for that, and we have one of those coming out, I believe next week. So, and with that, we'll let you go, and good luck trading, and be aware of a lot of the risks that are in the charts, and don't take everything for face value you're seeing being put out there. So, enjoy, guys.